How do I help my family and close friends with all the knowledge that I have about how to be the bank, about this amazing concept called the infinite banking concepts and how it can literally change people's financial lives? I have no problem with the 13,000 plus clients that I have. I have no problem helping about 400 people every month with this, complete strangers. But when I gotta sit down and try to help my family members and my close friends, who are people that already have built-in trust, know what I do, see how successful I've been with it, this is the most frustrating thing, and it isn't just me. If you were to talk to your friends and family about this, if you were to watch the 90-minute video, which is kind of our fundamental baseline, it helps walk you through exactly what the infinite banking concept is. It breaks down the mindset, it breaks down case studies using a car example and also a debt pay down example, and it shows you the mathematics. It's not difficult to understand this when watching the video. But today, I'm going to give you the questions that came from someone very close to me, somebody that knows me, trusts me, likes me, at least I think they like me, and we're gonna show you the questions they have, and I'm gonna try to play nice. I'm gonna try to keep my composure, but it's going to be hard. Let's dive in. I think one of the difficult things, and this is just everybody, is how do you appeal to people's desire to be wealthy, to be millionaires, but to then show them the practical path, the path that just about all the wealthiest families have gone on. How do you bridge that together in a society where everybody wants everything right now? Your way, right away, right? The McDonald's logo. But how do you do that in a strategy that takes time? Becoming a millionaire, becoming wealthy is a marathon. It is not a sprint. And if you think you're gonna get rich quick with this strategy, you're wrong. You're completely wrong. Getting rich quick actually fails almost all the time. So when I get into these questions, those are some of the concerns. I don't know why my family and close friends all seem to want to get rich quick, but really getting rich quick is stay broke longer. That's really what it is. But anyway, let's dive into some of the questions. There is a huge difference, okay? There's a huge difference between getting rich and staying wealthy. And it's right in what I said. I remember I spoke at an event out in California for hundreds of people, and I asked the entire audience one question. I said, what is the difference between rich and wealthy? Dead silence. A young 14-year-old man stood up, raised his hand, and he says, I know the difference. His answer was surreal. Here's what he said. He said, the difference between being rich and wealthy is simple. Rich people act rich, and rich people don't stay rich long. And then he said, wealthy people, real wealth, they have learned how not to give their money back. They have learned how to stay wealthy by being more conservative and not chasing unrealistic goals. And I think a lot of that can be summed up in the laws of wealth, which I'm going to hit them. But I do want to start with the first thing, which is the first law of wealth. Pay yourself first. So when I talk to any family member, friend, or even strangers, or people that just see me online, I always tell them you must follow the first law of wealth, and that is pay yourself first. For every dollar that you make, every single dollar that you go out and you earn, you must pay yourself 10%. This should be very simple, but when you look at statistics, by today's numbers, 2024, the savings rate in this country, the United States of America, the land of opportunity, is less than 3%. Oh my gosh, let that sink in. Less than 3%. When the law of wealth says 10% is the minimum. So we got to start there. So when people ask me, which is also one of the things my family members always start with, what's the minimum? That's simple. The minimum is 10 times your age. Not to be confused with 10%. 10 times your age is the minimum. So use me as an example. I'm 46 years old. If I add a 0 to my age, that's 460. That's my minimum monthly amount. 10 times your age monthly. So just add a 0 to your age. That's the minimum monthly amount. And if you want to know how much it was a year, then just multiply that times 12 months. and that gives you your minimum annual. But it always boggles my mind that when I ask people what they want to do, when I'm talking to them about becoming their own bank, their first thought is, what's the minimum? Their first thought should be, what's the max I could do? That should be what they should be asking, but they don't. They ask what the minimum is. So in other words, what you're saying to me, family member or friend, is you're saying you want to save the absolute minimum. You want to do the absolute minimum in life. You want to take out of life the absolute minimum, because that's what you're saying. You want pure safety and security in life. And it's the risk takers in life that are the ones that always make the most, do the most, have the most, and enjoy life the most. Think about that. The risk takers, the one that goes out there and risks it all on their worthy idea, that's the one that serves or solves a problem for the other 98%, because the risk takers amount to 2% of the entire population. Now, when I say risk taker, you're like, oh, I don't want to take risk. I'm talking about the people that chase their dreams, the people that go out there and create their destiny. Those are the risk takers. The conformers are the ones that play it safe, the ones that conform to somebody else's failed idea, somebody else's plan, somebody else's dream, somebody else's idea of what they should do. But let me go one step further with that, like risk takers versus safety, people of security. So people of security should love what I do, because if you don't know by now, what I'm going to teach you or what I'm going to talk about are questions that are derived out of a 90-minute video that we make people watch. That 90-minute video teaches a concept, a process called the infinite banking concepts, pioneered by the late R. Nelson Nash. But that process can be made more efficient through a product that you all know and most of you don't understand, called a whole life insurance policy. But let me just rephrase that. A specially designed, very specially designed whole life insurance policy. It doesn't matter how many times I say that. Specially designed and engineered, specially designed and engineered, specially designed and engineered, specially designed and engineered, specially designed and engineered. Doesn't matter how many times I say that. Every time my family members and friends go back to what they have heard about normal, off-the-shelf, whole life, which isn't bad, but it's not the same as specially designed and engineered. But it doesn't matter whether it's specially designed and engineered or the normal off-the-shelf whole life, they are all guaranteed. You ever see the movie Boss Baby? Remember when he says, brother, I'm gonna just emulate that, guaranteed. Hear that word? It's a strong word. It means no risk, because it's guaranteed. So people that like security and safety should love guaranteed growth, right? Well, you would think so. Let's dive into the next question. Complexity and engagement. So I'm just summing up this question, but basically they said it seems complicated. Wow, that's a new one to me. I'm not gonna lie, that's a new one to me, because complicated. Let me ask all of you a question, and I want your honest answer, and your answer can be put in the comments. How difficult or complex is it if all you need to do to be your own bank is change one thing, and that one change is where your savings goes first? Notice I didn't say goes forever. Where your savings goes first, okay? Change one thing, where your money goes first. Pretty simple, right? You guys with me on that? But then we got to add another step. And that one step that you have to add of how you use your money is what you already do today. But that one step is who you pay your money back to. Change one thing, add one step. Complicated? Let me know in the chat. Is that hard? And some of you might be like, well, it depends. No. Like, can all of you draw a circle? Let's just do this right now. Okay, on this side of the circle, I want this to be where your money starts, okay? That's change one thing, where your money starts, in a specially designed whole life. Now, that circle, we're gonna draw the whole circle, right? I just want you to draw it, and I just want you to imagine it just going round and round the circle, like Monopoly, okay? But on the other side of the circle, so this is where your money is, okay? This is the specially designed and engineered whole life, but we're not gonna keep the money there. We're gonna constantly move the money out of the whole life into the opportunity zone, which is the other side of the circle. Money is here, over here is opportunity. You're already doing this. You're investing money, you're buying stocks, mutual funds, ETFs, you're buying real estate, making loans, buying cars. Heck, you're even paying debts. So if we move money from this side of the circle to this side of the circle, what happens? Well, your money on this side of the circle in the specially designed and engineered whole life continues to earn interest and dividends. Doesn't change. The money on this side earns more money. And when it earns more money or allows you to take back money you were giving away in the form of debts, because the fastest way to wealth is through your own debts and expenses. No pun intended. But if you make money on the opportunity side, where does that money go? Now, stay with me because I know this is not complicated, but somehow my family members seem to complicate this. When you make money, where do the earnings, interest, dividends, all that stuff that you make, where does it go? Anyone? The bank, right? You put it into someone else's bank. You take the money you make and you deposit it in the bank, either automatically through ACHs, wires, or just deposits. You put it in somebody else's bank. That's the one thing we gotta add. We gotta add a different place for that money to go. So the opportunity zone creates more money, and now what we're gonna do is we're just gonna put it back where the money started. You're gonna complete the circle. So there's no leaks in your boat. You're not losing any money, you're not giving the bank any money, you're not allowing them to make more money on your money. You control the equation. Now, that is not very complicated, right? That isn't very involved, right? It is quite simple. You just created a circle and your money just moves from one side to the other and then back to the other side. Yeah, but for some reason, my family and friends want to complicate that. Let's go on to the next question. This one always gets me because I already mentioned that the first thing they always ask is what's the minimum? But then they also ask, well, is there a substantial investment? Well, first off, we're not talking about investing here, okay? We're talking about savings. There's a difference between investing and saving in guaranteed accounts because investing involves risk and savings does not. So when my family members always bring this up, it always blows my mind because I already talked to them about the minimum, but then all of a sudden they think there's some big amount of money. Maybe they watched another video I did where I talked about the dump-ins. Listen, here's the sum up to this one. There is no big chunk of money that you need to put in. Every dollar amount that you tell us you want to deposit into your banking system, i.e. that specially designed and engineered whole life, we will build and design and engineer the policy to hold that. So if somebody said, I only want to start with the minimum, great. We'll start with the minimum. I'll still never understand if you have the means to put more in than the minimum, why wouldn't you? I mean, it just kind of makes sense once you see the numbers, but anyway, we'll go with that. But if you just had 20 grand sitting in a bank account. Let's just say you had it sitting there for a rainy day. Oh, that's money I'm gonna save up to buy real estate. Great. Well, let's take that 20 grand away from the bank where they're just using your money to make more money. And in case you don't remember this, but banks, according to BauerFinancial.com, make 400 to 1,300% more than you do on the money you leave there. So, yeah, that's a good reason not to leave the money there. So let's take that 20 grand that's sitting in a bank account and let's just change where it goes first. Let's take it from the bank and put it into the specially designed and engineered whole life, where it's going to earn guaranteed interest plus dividends. And that brings me to the next question. They always ask me, well, how much is the interest and dividends? And that's simple. I always tell them, I say, the companies post a declared dividend crediting rate every year, which is a blend of the guaranteed interest rate that's in your contract and the dividend paid. And almost every company that we deal with right now today pays anywhere between 5.5 up to 6.2%. So 5.5 or 6.2%. Now let me just ask you, is your bank paying you more than that? And this is one of those weird times, because maybe they are. But do you think when the Fed drops interest rates, your bank will continue to pay that? Ah, now I've got you, because the answer is absolutely not, Mr. Family Member. Just because you're getting 5% at your bank doesn't mean next year you're gonna get 5% at your bank. But if you change where the money goes first, and it's in a specially designed and engineered whole life, I can tell you in your contract you're going to get paid that interest regardless of what the Fed does. So, when people ask me, well, what about that dividend? Is it guaranteed? No, the dividend is not guaranteed. But these companies, everyone we deal with, have paid dividends consecutively every single year, never missing one year, for over 140 years. They have paid a dividend consecutively every year for over 140 years. Now, you might be that pessimist that says, because my family members are, well, maybe next year's the year they're not going to pay dividends. Yeah, and maybe next year's the year the meteoroid from space is going to crash into Earth. And oh, maybe next year is the year that dinosaurs are going to come back on the planet like Jurassic Park. Oh, and maybe next year is the year where we're just going to basically have a massive blackout because of an EMP explosion. I could go on with the maybes. So maybe, I don't know what to tell you. For 140 plus years, they have paid dividends consecutively. Any more questions? Of course, there's more questions. Let's keep going. They always get hung up on the loans. So remember the circle. Money starts over here, moves over here to the opportunity zone, then moves back over here. But when we take the money from the policy, we don't actually take withdrawals. You're used to taking withdrawals from your 401ks, your brokerage accounts, and your bank accounts. You take a withdrawal, which is why when you take a withdrawal, there's less money in the account earning interest and dividends. But you see, with the policy, we are allowed to take loans. You know, they ask me, they say, well, if I put money in this policy, why would I want to take a loan for money that's already mine? This is actually a good question, but the video does explain this. So let me ask you this. We'll just play this. You got some money. You put it into the policy, and you got an opportunity to make more money in a real estate deal. So you want to take the money out. And then I tell you, well, the best, most efficient way to do that is to take a loan from the insurance company. And then the first thing, these people would ask would be, well, does the insurance company charge on the loan? Of course they do. Right now, it's anywhere between 4.8 and 5.25%, give or take a basis point or two, because I'm not getting it exact, just trying to cover my bases from a disclaimer side, because my family members will probably sue me quicker than anybody else. But anyway, so let's just go back to the numbers. I've got money into this policy, and I'm going to take a loan. Now, how much did I tell you that the policy pays you? Yeah, it was like 5.5 to 6.2. And how much did I just tell you you could use your money at? You do remember that, right? 4.8 to 5.25. Anyone doing the math? Please tell me you did the math. Because if you did, you can understand that that is a spread. Because you're making more than you're actually paying. But see, that's not the real reason. I mean, yeah, spreads are great. That's what a bank does, right? A bank pays you 5 on your bank account. If you got a bank paying you 5. But what do they charge you when you take a loan? Probably at least 7. They make a spread of 2 points. So over here in your banking system, that policy, when you take money out at a lower interest rate than what you're earning, you make the same thing, a spread. But see, here's the real reason we take loans. When you take a loan, first off, there's no taxes on that. So even if you were taking your gains out, because it's a loan that technically needs to be repaid, that loan is tax-free. It's tax advantaged is the word I should actually use. But not only that, when we take a loan, does our money actually leave the account? Oh, no, it does not. Matter of fact, the insurance company, when they give us a loan, they give it to us from the general account. They subtract it from our death benefit, Mr. and Mrs. family members. Yeah, your death benefit, the thing you said you didn't care about. Then you shouldn't mind that the insurance company actually takes the loan you take from the policy off of your death benefit. So if you die the next day, they pay out the amount of your death benefit minus the loan you took out. Your cash value just collateralizes the loan. But that means that now all of your money, all of your cash value is earning interest and dividends, and you're able to earn interest and dividends on an uninterrupted compounding basis while you get to use the money at the same time. So you effectively, if you haven't figured this out, get to make money twice on the same dollar. But that goes into the next question. The next question, and actually, depending on what family member and friend, this is usually number 1 or number top 5, fees.
Oh, those whole life policies, they're so expensive. I'd be better off buying term insurance than buying the whole life because of the fees.
So let's break down the fees in a whole life. This is quite simple because there's 3 of them, okay? Number 1, there's a policy service fee. Now, buckle in, brace yourself, sit down because you might fall out of your chair. It is a whopping $50 a year, and the most I've seen is $100 a year. You okay with that? $50 a year or $100 a year. I'll bet you pay more on your savings account per year because your savings account loves to nickel and dime you the $5 every single month statement fee and the NSF fees. If you overdraft, you can't overdraft your whole life, just so you know. That's like what, $35, $34. So you see what I'm saying? $50 to $100 a year is peanuts. So that's fee number 1. Fee number 2, and this is the one they always love to hit, Commissions. Oh yeah, those greedy insurance companies and those greedy agents make all these commissions. Now hold on. Remember I said earlier, these whole lives are specially designed and engineered. And when we specially design and engineer them to work for the infinite banking concept, you know what we do to our commission? We reduce the commission through the design by no less than 60%, but sometimes up to 90%. So we literally take a cut in our commission of 60 to 90%. Yeah. Why would we do that? Well, because that's how it works. Yeah, because we have to give that commission up so you have 60 to 90% more cash value to use immediately. So that's number 2. And number 3 is the cost of insurance. Now, this one is the one that everybody gets hung up on. Oh yeah, I knew it. There's a cost to that death benefit. Oh, those greedy insurance companies. I'd be better off buying term insurance. But hold on. I love this one. It's always this term and whole life thing. And pretty soon I'm gonna have a video that's gonna mathematically prove that whole life is more efficient than term, and buying term invests the difference. So anyway, I'm just gonna tell you, I'm gonna fix that misconception. So the cost of insurance. Yes, there is a cost for the death benefit. Insurance companies are not non-profits. And matter of fact, you don't want them to be, because then you wouldn't get a dividend. So you get a dividend because they are profitable. And yes, they're very profitable companies. They've been around hundreds of years, have hundreds of billions of dollars in surplus in some examples with these companies. So of course, yes, they make money. And how do they make money? Well, cost of insurance. So they give you a death benefit. That's right, every policy, even specially designed ones, give you a death benefit. So how do we do that design and engineering that reduces our commission by 60 or 90%? Well, what we'll do is we'll put the lowest whole life base death benefit on the policy. Yeah, but there's rules. There's IRS rules called the MEC 7 pay. So we got to fit within them. But we're going to put the lowest death benefit on that we can. Yeah, that's very different than what your financial advisor tried selling you. That's very different than what your broke-ass brother-in-law tried selling you the other weekend. We're putting the lowest death benefit on. But then, to meet the IRS guidelines, what we're gonna use, and drum roll please, term insurance. That's right. You see, these insurance companies are so smart, they have allowed us to build in a term rider. You love term insurance, you already said that. Family member, you wanna buy term, invest the difference, that's the best way because you've been lied to. But anyway, we use term insurance, but we use term riders in the policy only for the amount of time that the IRS requires us to use them. That's right, usually for 7 years, MEC 7 pay for 7 years. So we do use term insurance, and why? Well, the same reason you've bought into this whole lie about term insurance. It's cheap. You want the cheapest thing. Great, so you must be that person that drives the cheapest car made. You must wear the cheapest clothes made. You must eat the cheapest food when you go out to a restaurant. You must do everything on the cheap, right? Because you want the cheapest. Oh, you don't? You drive a BMW? That ain't the cheapest car. Is that a Gucci bag I saw the other day? That ain't the cheapest bag. And you actually go out and you order salmon or filet at the restaurant, that's definitely not the cheapest meal. Salads are the cheapest meal in most cases. Well, not always, but from what I grew up remembering. So you're not a cheapskate. I don't mean to call you a cheapskate, but you're so concerned about fees and cost of insurance and cheap that you buy term insurance. Do you know that term insurance is, in the long run, the most expensive life insurance you can buy? Because only less than 2% of it ever pays out. In a whole life policy, you can never outlive the death benefit. Anyway, am I going too far with this? Let's move on to the next question. Because the next question is always one I can't ever understand why they ask. And that is where they start to try to compare being your own bank, the infinite banking concept, to a 401k. And this always comes up with family members. They're always like, well, how is this better than the 401k? And I'm just like, please no. Please tell me you did not just ask that. But you know what? Please tell me that you would love me to give you some really good wisdom right here. Well, I'm going to. Actually, that wisdom is click the subscribe button right here. And there's a little bell up top. Smash. Oh, hit the car. It never fails. Every time I do that smash thing with the punching bag goes flying and hits something. Sometimes it hits a person, knocks a glass of water over. Today, it hit my car. Anyway, who cares? So, back to 401ks. They ask me, how does this differ than a 401k? You know what I'm always thinking? You didn't watch the 90-minute video, did you? A 401k, that thing you've been kind of told to put all your money in, from a young age. I was told the same thing. Grandma said, hey, Chris, ask if they got a 401k and ask what the match is. I said, okay, Grandma. And I used to put a bunch of money in my 401k when I had one. I no longer put any money in a 401k, but if you must, there is no comparison you can really make between a 401k in the private banking systems that I'm talking about. Because a 401k is a qualified retirement plan. Let me just say that again. Qualified retirement plan, and that means there's some rules. First rule is you can't take your money out prior to 59 and a half without an IRS penalty of 10%. Yeah, that's the early withdrawal penalty. So if you start putting money in a 401k, I hope you understand that you can't take money out until 59 and a half. Although that's actually kind of not true, because you can take a loan from your 401k, but only up to 50,000 or 50% of the value, whatever's less, okay? So that right there is the difference. Privatized banking, these specially designed whole lives are non-qualified money, meaning non-retirement, meaning no rules, meaning no liquidity, restrictions before 59 and a half, no penalties for taking money out early. None of that stuff exists. It's like your bank account, non-qualified bank account. So I don't know why we got to compare 401ks to this, because there is no comparison unless we start talking about, well, what if I take a loan from the 401k versus the loan from the policy? Now we can start getting similarities, except there's one difference. When you take a loan from your 401k, they mandate how much you're going to repay back to your 401k per pay period, and they will take it right from your paycheck. They set the rules. When you take a loan from your policy, you're the bank, which means you make the rules, which means your repayment can be anything you want, any way you want, any interest rate you want. So you are in control of your money and your terms. Over on the 401k side, you are not in control. Secondarily, when you repay the 401k back, if you don't pay it back and you lose your job, quit, or whatever, that excess that you didn't repay must be paid back upon that event. So like getting fired or quitting. The loan that you took from the policy, well, I'm going to tell you this, the insurance company will never ask you for that loan back because they want the interest on the loan. So why wouldn't they want the loan back? Well, because they know one thing for sure. You're going to die someday is what they know for sure. And they know that when you die, they're just going to subtract the loan outstanding from your death benefit. So to them, it's a zero-sum game. Yeah, so the 401k, yeah, it doesn't play that game. Now, that's the only similarity between a 401k and privatized banking. Outside of that, the mechanics, the reasons, everything else are totally different. You put money in a 401k to get a tax deduction. You don't get a tax deduction for putting it into the non-qualified private banking. In the 401k, the money grows tax deferred. The money grows tax deferred just like the 401k in the policy because it's a tax advantaged account. But the restrictions are not there. Did I beat that one into the ground too much? Sorry. It seems to come up a lot. Now this next question, I will tell you, not every family member or close friend asks this, but it does come up. They say, well, why would I buy cars this way, paying cash for them versus leasing? Isn't leasing better? Let's talk about leasing. So leasing, you go and you get a car at a dealership and they come up with this deal for 3 years or however long you want where you make payments to the finance company. But you know that those payments on that lease include interest? Oh yeah, there's a big old interest rate factored into your lease. And there's a whole bunch of things stacked in a lease against you. So when you make that payment, although less than the financing option in most cases, the lease payment, you keep none of that money. So you've lost the opportunity cost on every payment. That money's never coming back. But the worst thing is when your lease is over, what do? You hand the keys back to the dealership and you don't have a car. So what do you got to do? Start over again and lease another car. So that's a great one, right? You never own anything. You give up all this money, but yet you think you're winning. And the biggest thing people always say, yeah, it's a write-off to my company. Do you know that you can depreciate your entire vehicle if you're using it for business, using a 179 deduction? You can't really do that with a lease because you don't own the car, but you can if you buy a car. Do you know that when you buy a car and use it for business, consult with your CPA on that one, you can then write off mileage? And you realize that works out to be actually more in most cases than the payment you write off for the lease? So why is the lease so good? When you use the infinite banking concept, this private banking system to buy your car. As long as you complete the circle, which means you never steal from your bank, here's the best part about it. You will always get every dollar back for every car you buy, drive, and own. So when you lease a car, do you get every dollar back for every car you buy, drive, and own? Actually, just the opposite. You never get anything back. You just bleed. But when you do it this way, you always get all the money back for every car you buy, drive, and own, and you don't have to sell the car. So when you sell the car or gift the car to your kids or a charitable foundation, how is that such a bad thing? You're actually making money for buying cars. You know, when I was at the dealership, I explained to them how I do this because, you know, I was talking about the financing and I said, I don't need financing. You know, we're just going to use our private banking. And I explained and he says, holy crap, that's brilliant. That's what the dealership guy said. His name's Joe. He said, that's brilliant. How come everybody doesn't do this? Well, I guess not everybody can save because they don't follow the first law of wealth and save money. But my family members, they seem to think leasing is better than getting all the money back for every car you buy, drive, and own. Now, let me give credit to one thing on leasing. Some people that have not been able to save up enough money to pay cash for a car, they lease because it's the convenience factor. They get a lower monthly payment, they get to drive a brand new car, and they don't really care because every 3 years they get another new car. I kind of get it. But I don't know, when you start looking at the math and how much money you give away, it really becomes a very difficult thing. But if you're leasing now, great, but maybe now start saving so that down the line, your banking system can finance your next car. I'll give you an example. My mom is a perfect example. Now, my mom is the one person who doesn't fight me about this stuff. She loves it, but she doesn't really fully understand it. And not long ago, I think about a year ago, we leased another car for her. She just gets an Equinox. She loves those things. But I said to my mom, I said, when the lease comes up on this, you have to promise me that at that time, we're going to use your banking system to buy out the lease, and we're going to make the same lease payment, because that was her big thing. Oh, it's the lowest payment. I need this low payment. Okay, Mom, you can make the same low monthly payment to your banking system as you do to Chevy Financial or whatever, GM Financial. And she says, oh, well, yeah, we'll do that. And I said, and you realize, Mom, you'll get all the money back for the car when you do it that way. That was my mom. So my mom, her lease has still got 2 years, but in 2 years or somewhere close to that, her lease will come up and we will have this discussion. And remember, she made a promise. She's going to use her banking system to do it. Awesome. Oh, I forgot one thing about my mom. You know, my mom likes driving the newest models for safety and convenience and all those things. So under this scenario, like I just mentioned, where her banking system buys the car, that doesn't mean that she can't take that car, trade it in on a new car in a year, 2 years down the line, get the new car and make the same monthly payment back to her banking system. So for the first time, she gets off the finance wheel and she levels out her payment. She wants the lowest payment. Well, because she owns the banking system, she sets the rules and the terms, so she can keep her monthly payment the same. If she finances or leases with the dealership every year, don't cars get more expensive? And that means lease payments get more. Every year she's leased, her payments have become higher when she had to get a new car. That's just the nature of the beast. But with her banking system, she makes the rules. Does that make sense? This one I kind of already hit, but this is a question that came up. How do you justify the higher premium payments? I love that. Payments. They're still in the mindset of payments. You're making premium deposits, but how do you justify the higher premium payments on the whole life versus term? Okay. This is a very simple one for me to justify for your premium deposits. Because let me put it this way. Let's just say you take out one of these specially designed and engineered whole life policies and you compare it to a term policy. The whole life policy, yes, your premium would be higher than it would be with term. So if we're going to just apple to apple comparison, yes, the whole life would be a higher premium than the term. But the whole life, designed the way we do it, most of the policies we design have a cumulative break even between year 4 and year 6. So what I'm saying is you make that higher premium payment for 4 to 6 years, and in 4 to 6 years, you got all your money back because your cash value has exceeded the amount of premiums you've paid. So now what's more expensive? You put money into something at a higher velocity, so your payment's higher for 4 to 6 years. But then in 4 to 6 years, you have enough money in there that if you canceled the policy, you could take all your money back. Or if you took a loan from the policy, you could take all your money back. All of it, maybe even a little bit more than what you put in. The term policy, you made lower payments, because it was cheap, like the bag you wear, cheapest bag, food you eat, cheapest food, cheapest car you drive, cheapest house you live in, you're just cheapskate, right? So the cheap term policy, but your term policy, you got to pay for all the years of the term. So let's call it a 20-year term policy. You make premium payments at the lower velocity for 20 years, and in 20 years, your term policy ends. Does the insurance company give you all your money back? Does it give you any of that money back? No. You bought the policy to cover you for a term of time. And if you live past that term of time, which 98% plus of you will live past that term, you get none of the money back. So what's more expensive? The term policy that you never get any of the money back, or the whole life policy that you're pretty much guaranteed to get all your premiums back? I'll let you answer that. Because my family member still seems to think that the term is the better choice because it's cheap. I'm just gonna stop there. I'm gonna be nice. I have a lot I want to say. Now, we're going to move on. All right. So in the sake of time, and there's a lot more questions that they had, I'm just going to read them off the paper and we're just going to hit one-liners. Fair enough? Because you guys might not be wanting me to go deep into this. This one was self-payment clarification. So they asked a question regarding the recapture of the money. For example, if I take a loan for my policy and I pay off Visa, and Visa no longer is owed any money, but now I take the payment I used to give to Visa and I put it back into the policy. They wanted clarification on that. Now, let me ask everybody a simple question. If you're paying 20% in interest on a Visa and you pay Visa off, but you make the same payment back to yourself, what return on your money did you effectively recapture? 20%. How many of you want to make 20% on your money? Everyone, right? I just showed you how to make 20%. Any questions? So there's your clarification. They always say, well, what about the hidden fees? In the 90-minute video, I show a bunch of numbers. But you realize those numbers are net, net, net. Net of policy service fee, net of commissions, net of those expensive cost of insurance. Those are all net. So the numbers you're looking at are net numbers. So for example, in the chiropractor's debt pay down, if you actually watch the 90-minute video, family member, in there, I show in the 6th year of that chiropractor's example, he puts $10,000 in premium deposits, let's get that right, not payments, deposits, into the policy. And how much money could he take out? How many of you remember? Put it in the comments. That's right, over $13,000. So what was his return that year? He put 10 in, took 13,000 out. 30%, right? His cash on cash return was 30%. Do I really need to help you understand that? Plus, he was paying off all of his debts with the money. So he was earning uninterrupted compounding interest. Plus, he was making all the money from recapturing the debts that he paid down. Remember I said the 20% on Visa? Yeah, he's paying that back to himself. It's the fastest way to wealth, through your own debts and expenses. This question they ask, but I don't really know why they ask because I explain it pretty well. So the debt mapping services, is there a cost for that? No, in the video I said it's free. We provide that service for free. So once your policy is issued and funded, we will then show you how to implement the infinite banking concept. And we do this for free, and we work with you every quarter for free. Any questions about like the word F-R-E-E? It's free. We don't charge. How do we make money? Well, remember I said we take a reduction of 60 to 90% in our commissions? Yeah, you might say, well, why would you continue to do this? Because I understand that when you give, you get. It's a universal law, kind of like gravity. When I give, okay, I give my commission up so that you have more cash value to use in your policy immediately. But what that results in is me getting. And what do I get? Scale. I get to help thousands of people. So even though I make 60 to 90% less, I'm helping thousands and tens of thousands of people. So if you understand scale, you understand that's the right choice. And another question came up about why would I want multiple policies? Well, why does a traditional bank have multiple locations? Have you ever seen a traditional bank with just one location? No, they have multiple locations. Why? Because it expands their deposit reach. They get to attract a wider deposit reach because most people bank within a certain demographic area around their home. They want the closest bank. So if there's not a bank close to them, they'll go to a different bank and deposit money there. So banks have multiple branch offices. So in your banking system, your multiple policies or multiple branch offices, because think as if you're the bank, are due to the IRS limits. If we build a policy for you for, let's just say, the minimum, Mr. and Mrs. Family Member, you want the minimum, so you add a 0 to your age. So let's just say that's $500 a month. But then you realize that this actually works and you realize how good this actually does work. You then want to put $1,000 a month in. You can't. The policy I built for you is $500 a month, not $1,000 a month. So the second branch office, your second policy, allows you to increase that to the $1,000 a month. And then your third would allow you to go higher than that. So each policy increases your ability to capitalize your banking system. And if you are starting to pick up what I'm putting down, you want to put as much money as you can into your private banking system because you want to save more money. I wasn't going to bring this one up. And I'm rapping, folks, but this one pissed me off. And that's why I wasn't gonna bring it up. In the 90-minute video, which most of you have watched, there's an example where we do a case study about a chiropractor who was $578,000 in debt, paying $5,600 a month to credit cards and debts. Now, this family member asked the question, wanted me to clarify the chiropractor debt example. Now, let me actually give you, this is what they said. Can you provide a more accurate comparison in scenarios like the chiropractor's debt using real rates? So what, I was lying about the rates? Do you realize the insurance companies would literally not allow me to work with them if I was lying about the rates? Using real rates and fees to reflect the true savings of the infinite banking concept. This family member is lucky that, we didn't have an episode, but I'm not gonna say what I really was thinking. And there's a couple more questions, but I'm just gonna wrap up with this one. Can you show me additional wealth building methods? So can you explain the role of the infinite banking concept in terms of wealth building compared to more traditional methods like investing in the stock market, real estate, and businesses? Easiest answer ever. This is the and asset, as my buddy Caleb says in his book, The And Asset. It's this and that. So I don't need to compare because you're changing where your money goes first, and then you're investing at the same time. This and that. Not this or that. This, the policy, and the investments. The and asset. Anyway, with that being said, folks, thanks for joining me for this. I really hope you've enjoyed this. I've tried to really keep a positive mental attitude going, but at about minute 20 something, I just couldn't. I'm sorry. So with that being said, we'll see you next time. If you like this video, check this one out because obviously some people need to watch the 90-minute video more than once, and there's the new one. We'll see you next time.